quite the talk, right? Fed funds rate, the Fed is cutting rates. You see a lot of content out there about how it's going to affect mortgages. But what is a Fed funds rate? When I ask people, it's hard for them to give me an answer. So I thought I'd just give you a quick explainer. The Fed funds rate is a lending rate, right? It's a very special lending rate. It's a lending rate between banks. And it's a lending rate that's for a very short period of time, overnight. All of the banks, right, sometimes need capital. They all have things called reserve requirements. They have to hold a percentage of capital back for regulatory purposes. Banks may have cash needs. What they can do to fill that need is borrow money. And they can borrow money from other banks to fulfill that need. But that borrowing is literally overnight. The Fed funds rate isn't a rate available to us as consumers. This is a rate available to banks for interbank lending. But it is the basis that drives or influences every other rate. So how does the Fed funds rate affect you? Most importantly, it affects the prime rate, right? Which is a traditional consumer financing rate. And if you can think about it, the prime rate is always 3% above the Fed funds rate. So immediately as the Fed funds rate moves, prime rate moves. And traditionally, any type of lending product that has a duration under 2 years will have significant movement with the Fed funds rate. Anything beyond that isn't nearly as impacted as much. It influences it, but doesn't have a one-to-one impact to it.